Hello, guys. Good evening. This is the markets with Odinga. I always start with the project, which is what I recommend everyone that is listening to me to start doing. That is to build a mindset of an algorithm that you can use to either trade for you in the future or install it into some machine or mechanism that you will be deploying to trade for you. I am the consistent, profitable, independent, informed thinking, especially informed thinking trader, and I'm programming an algorithm with backtesting and journaling, or going back to old data, testing my model, testing the theory, which is the language that we have learned from, pardon me, the mentor, testing it on old data to find what suit us best, what fit best to our personality, meaning that whenever you have taken the course from ICT or have access and start studying with him, he is explaining a lot of PD arrays. He is explaining a lot of model. I think he have 81 ways how to enter a trade, and with a lot of models that he have made public to the community. Whenever you take a course, be it the model 22, 41 videos, 41 study hours. If you cover that and it match with your personality, that you will going to be trading the model 22. In another playlist he call it model 13. It is recommended to go first, and that is actually what he is saying, that new trader must go back as far as old data allow, journaling, case study, working on seeing the model in the past, how it has paint out in the past, and then after you backtest, you journal for like 3 months, and you have been seeing your model with what you become familiar with. Then the next step is to tape read, to gather experience without any monetary or without any loss or profit and loss, monetary risk. Um, that is what I am doing with this algorithm, and everybody that is linked to this channel, that has subscribed and is following what we are doing here, it is highly recommended to start building your own book and start building and programming your algorithm. I'm greeting you from Suriname, and uh, under I am respecting this disclaimer and asking you to pay attention, knowing well that trading, whatever market, does have um, some risk with it. So it is recommended for you to contact first your financial advisor before you engage the market. Here is the book 7 that I have opened. I think I opened this book on the 7th, on the Sunday, last week Sunday, and I have been journaling, case study, like I just told you, and have been programming with backtesting and journaling, with analysis, and with seeing seeing examples on old data, seeing the market open, and here we are. Today was, let me go to the market. This is the channel. You're welcome to join us. Welcome to join us. We have not engaged the market today because our protocol called that on a non-farm payroll week we will be looking for trade on Monday, Tuesday, Wednesday up till 11 o'clock. We will not engage on the Thursday till Friday after the event. So after 9:30, 10:30, when the event, the news driver has settled, then we can resume going into the market and engage the market. So today was a day off. I use it to study, to do some things outside the chart, and to have a day off today. That is why we will not see that we have any annotation on a chart on this day. And actually we are glad to see what we have seen here, what the market has delivered or have paint out. What we will do is that we will go from the daily chart. This will be a quick review. The daily chart, and just as we have said yesterday, we are so happy to see this all. We have said yesterday that because of this rally, if you go to, I think it is this video, how to conduct daily review, and this video, how to conduct a daily review and analysis that will enhance your trading experience. We have then there predict that we would most likely see price trade a little bit further into the buy side, drop way low to the midst of this busy, to the mid of this busy. On the lower time frame, we will clearly see what I meant saying that all, and then trading, creating a small body trading day. What we can do right now, because we already have the Thursday 6th of June trading day, we can go and do this annotation, put on Wednesday, from Tuesday, Wednesday and Thursday. These three candles, we see price has create a gap, and whenever we see a gap like this on the daily chart, I use the blue color. It is called a buy side, imbalance, sell side, inefficient, and meaning price most likely, the market most likely will draw to make efficient this gap, or trade to the consequential encouragement, or trade further. This is the information that we have now from the daily chart. I always recommend you to create any long wick that you encounter, or long tail in this the trading day of today. We have seen a strong rally, open, price open, trade higher, create a high, and then drop low to then close below the open. So it is a down close candle, but it left us a long tail. And whenever we see that, we grade it in the upper 25%, which is blue, and we call it the first lower quarter, the first 25%. And then we have also the consequential encouragement, that is the midpoint of that the midpoint of that tail, 7. And then you have also, that is the 50% is here, which is a consequential encouragement, the 50%. And almost it's the consequential encouragement, it is the 50%. The mentor always like to say, when price encroaches to this tail, price most likely will respect the middle point of this tail. So we will be going into the day of tomorrow expecting price. It is the non-farm payroll day. This what we are seeing. There is a busy down here. Price has traded to and engaged first a 2 weeks ago high, 2 months ago high. Yesterday when we were here, we have predicted price to rally and leave us this tail. I just told you where to find that analysis. That is on this. You go to the channel, and then when you can see this video that we loaded up yesterday, where we make the prediction that price will be doing exactly what we have seen this day. We have not engaged it because of the non-farm payroll event week. Our policy, our protocol have called for us not to engage, but because we have not engaged, that now the landscape is clear for us. We can see that price have traded up, open up, engage much more of the liquidity above this high, and then trade way down, leave a gap, and then trade up. What we are expecting with the non-farm payroll day is, I'm looking for price to drop lower, to this, to make balance this busy, to offer sell side and then continue to go lower, even if it is to engineer price. But for it to do that, we will be looking for on lower time frame like the 4H, if we will be seeing a spike up with the non-farm payroll and then the drop lower. We are now forming actually the trading idea with which we will engage the market tomorrow. I will give this title. The title of this analysis will be, you want to trade CPI number, do not trade it before the event occur. Do not enter trade before the number occur. And that is what I will give this daily review. I will give it that title, because we will not try to, we are just predicting, thinking where they might take price, but that event lends itself for manipulation, and that manipulation can be can happen through a algorithm, or it can be manually intervention. That intervention can be algorithmic or manually. So on the 4 hour, if we drop to the 4 hour chart, we see that price indeed has traded twice, have traded one, two, twice, and still price have traded in a way that we can expect them, the market maker, the algorithm, to, even with non-farm payroll tomorrow, to rally first, to engage some of the more of this buy side liquidity, and that what has been engineered above these relative equal highs, the liquidity that has been engaged, that has been engineered and left above these relative equal high. We expect price to rally with the event, to engage that, and then drop lower. Um, we are looking here at a volume imbalance that is on the 4H. We'll go ahead to market volume imbalance, and we will be looking at how price will trade and use this volume imbalance, if it will use it at all, but we have it marked on our table. These four candles, they are one, if we are looking at a order block, from order block perspective, and we are thinking we are going down, then from here, from this this opening, this closing price, open, high, low, close, this closing price, we will be marking this. Counting this as a bearish order block. From the 4-hour, because of this violation. All these four candles are counted as one bearish order block. There are advanced explanation how and why we do that. I think the best person to explain that is the man himself. That is Mr. ICT, Mr. Huddleston. So it is recommended for you to go to his Fry library and study what he made available to the public. For now, we are looking at these from the 4H perspective. These relative equal highs, having above them two form of buy side. Those that going down have set above this these relative equal high, have set their stop loss. Those that selling, is a protected stop loss. Those that trading with breakout strategy have placed their buy stop order, believing that the market will take them into a long if it break past this swing high, right, and relative equal highs. All these three, there is buy side liquidity above these highs. We are looking at on the 4H basis. We are also seeing this there, which is a buy side imbalance to sell side inefficiency. You're considering it because it is this candle, this long candle, open, low, high, and close. Candle 1, candle 2, candle 3, and this gap, the low, the high of candle 1 have not matched the low of candle 3, meaning there is only sell side that has been offering on this side, and the market most likely will draw and and go to the to make efficient this imbalance. What we have seen, and in the delivery of price today, we have seen that price trade to the high of the daily BSI, have moved strongly and have stayed in the upper quarter of this BSI, and left for us a a tail, which we normally grade it, and I will just do this 25%, 25%, 75%. Now we have both from the 4H, or the 4 hour, and the daily. We have graded level of this SEBI. See that the market have only tailed below this swing, this BSI, and there is still room, a small, let me put this on. There is room for the market to continue, or we are going to be looking for the market, this is what we call institutional order flow entry drill, a drop into this BSI. They have already made this one inefficiency and leave this long tail with a consequential encouragement of it right below the one from the daily chart. We don't know what they will do with the non-farm payroll data. We will be looking at the market and see how they will trade and use that data, what side they will engage first, and what will be left to be traded after they engage that side. It is most likely, it is obvious for us from this daily 4-hour chart that price most likely will rally first to engage, will most likely engage this relative equal high, but it may drop even to this quarter, upper quarter of this tail, or till this consequential encouragement of this tail, and then rally toward to engage this and drop down. I want to see something like this. Price switch from here, drop to there, rally to engage that one, and then collapse to the sell side. That is what I would like to see. That is what I am building from the analysis, trying to get a schematic, a profile, a trading profile schematics in mind, looking at stop run, possibility for stop run, looking at liquidity about marketplace, and inefficiency that is left, that is below marketplace. Here we see this 1 hour. This 1 hour BSI is still active. What we will be doing is we are dropping to the 60-minute. We are going from top down analysis, and from this 60-minute chart, we already are looking at these smooth highs that have been left here, giving the less informed traders room to think that above these highs lies orange, and above these lies we have a safe haven, strong safe haven. You can put it on the center. It gives them that idea as of this is strong resistance. It cannot be be broken, and here it have traded to this line and then create this double top and now a triple top. What we are doing, that is institutional trading, algorithmic traders, we are focusing to engage to rate the stop, the protective stop that are here. Trap also the trader that have their buy stop orders above here, want to trade breakout, trap them into going long, and then reprice with smart money to engage this drop. We don't know, that is the tomorrow is the CPI day. We don't really know what they will be doing with the data, but this is what we are doing. The mentor always say these days are days for you to study study how the market engage liquidity. So for now, what I will be doing is that I put it on the background. The 4H is now on the background. I'm putting it on the background, and one is volume imbalance. I will also put on two background. The daily I put on one background. So at the background you have the daily chart annotation, the 4H annotation, and now I am doing the 60-minute annotations. Looking here, we are seeing that this busy have already been made balance. There's no need to have that one. This one can be used later, and the reason there is a trade to it, to and through it, but we would like to see a body place over it for us to consider it and not be a valid busy anymore. Here we still see a SEBI is down here. We have this bullish order block, and what we will be going to watch how the non-farm payroll event will trade and use this level. Also here we see first, actually we are now forming our narrative, our tradings idea. Here we see a swing low, 1 2 3 candle that has been taken here. Even this inefficiency have with this drop on today's trading day, making this efficient. This one have been made one pass efficient and have snapped higher. Now in the snapping higher, we just see these drop and so forth. If this candle had violate this open, I would be very sure that we would have be going higher, because of a familiar pattern I like to see. When I have this one violated and close below it, the next one or the candle that follow will expand higher. If not, we are just waiting for the change of state of delivery from this candle. The one that follow below it, will use it to trade higher, and that is the idea, the trading idea for tomorrow. We are predicting now. We are analyzing. We have analyzed, review, and now we are predicting. We are looking for price to run to this to engage these the liquidity that is above this marketplace, above, and now already on the orange, the liquidity that is above this marketplace. There is a long tail here, and what we are saying, it is what we try to instill, is that every time we see this long tail, we grade that tail, and in this the 4H graded level of 4H tail, or just as the 1H, the 60-minute H. So we will just change the color, the same, 50%, the same, 50%, the same. After this record, I will go and do the back testing and the recording. I will be making some positive thing. I'm glad that I saw that price has dropped to take this swing low and snap higher. I had expected this move. When I saw it, I was very glad seeing that price is going hard further after it has engaged the sell side and trade into the busy and past the busy. It have not yet taken a swing high, so meaning price is poised to trade higher. That is the idea. We are going to look for price to trade to take a swing high. In this case, it is the relative equal highs that we are seeing here. I think personally, because of the body, the structure of the body, that it will be just a snap high to take it, and then to trade lower and engage and trade toward the sell side. But because it is non-farm payroll, that event is an event that can be used, and that most likely is going to be used to manually intervene the market. We don't trade ahead of it. We stay clear from it, and afterward we come and engage the market with the analysis that we have and what the landscape is telling us. Sell side liquidity. Below this one, we have now this relative equal high. Actually, price is now in what we can call the above the premium. So we are expecting price to either spike higher from this range, give us a premium range, swing high taken. Here it is a dealing range. We are in premium. Price can drop, and that is how I'm going to be watching tape, reading the chart. I'm expecting them to read this one. I'm seeing this dealing range that has been created. We are now in the dealing ranges in premium, so we might drop first to the discount and don't stay long there. Trade to engage this relatively and then collapse further to the sell side. I'm going to look for something like this from the opening. Even if it's not this opening, that price drop to maybe to the consequential encouragement, giving the impression price is going down. Trade pass this volume and balance, use it, go and engage this safe haven, the liquidity that is above these trade all up to there, then drop maybe using this one, and then trade lower. This is what I'm going to be looking as schematic for the delivery of tomorrow, and seeing it like this. If it began to pan out like I am seeing here, I will be looking for the market maker sell model. I will be looking to trade nimble this buy side curve until we find the 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 the, ma- the smart money reversal, which can be in the form of, let's change this color, which can be in the form of a breaker, high, high, low, um, yes, low, high, yes, this one, higher, high, and then trade to this one. I can bring here. It can be a reversal like this, right here, somewhere here, or here. When I see this swing low taken, I will be consider it to be or it will be a failed breaker, and I will be using this model. So I will be watching price with in mind the market maker sell model. I can then trade breaker from here. In the accumulation, I can trade a bearish OTE, optimal trade entry. I can look for model 22, model 13 at the side. I will be just hunting this buy side delivery, this buy side curve, uh, to see if it is true this model that will be this market model maker model they will deploy for this trading day. And that is we are saying that is after the non-farm payroll. I want to see the non-farm payroll first drop down aggressively, maybe all the way and left this swing low very aggressively, giving trapping some trader. We are going lower. Stop short to engage this low, swing low. It's not relative figure, it's swing low. Stop short to do that, and then use and then trade, which this one will be the first Judah swing, this being just manipulation, and this rally to engage this to now bring these traders, or maybe we see this and then come there, and then to bring this trader in, and then this side of the curse I will be focusing. Hopefully that this will paint out after 10 o'clock, after the non-farm event happen, that we will see the sell side delivery, which will be a smooth delivery, and it can trade all the way up to this order block. And tomorrow is a Friday. It is not a day to do too much. If you don't see your idea, the narrative, the schematics, based on your analysis, if you don't see it come out, don't worry. Don't be in a haste to put a trade. Just wait. Next week will be a better week, if not the day after next week, and wait for your high probability trade setup, and wait for your analysis to come in play, and then engage the market. I will just go to the 15-minute, and like we are saying, from the 50-minute, we are definitely see that this is engineered liquidity. They give, it's giving the retail trader this is really strong resistance. And here what algorithmic, what we are saying is that the the smooth highs like to be made jagged, so price will trade. I'm seeing here, we're seeing one inefficiency here. Price can trade, there is relative equal lows below this. And let me mark it. I will just go and watch, as I will be watching price, pay attention to these these inefficiency, how price trade to and through them. You see what they will do with them. I put a 60-minute in the background, and then I will have the 50-minute now in the forefront. That's how I annotate my chart. This is now a swing low. This is actually a small, what we will see, balanced price range. We will see how the market will trade and engage, how they will engage this what we are looking for. We want to see with maybe from the opening that we will see drop, that is midnight London session, a strong drop, confirming this sentiment, this feeling that we have really a strong ceiling resistance, and then drop during London, start rallying toward these relative equal highs in the pre non-farm payroll event, and then when they are here, they will smash us down, and we start seeing the real move toward the sell side. That is the idea that I will be going in, hunting the delivery of tomorrow, after non-farm payroll event. I'm emphasizing it. Do not trade ahead of non-farm payroll event. Wait, give the market maker, give them the market the room to do their things before non-farm payroll. It might be that non-farm payroll before that is very quiet, a very quiet day, and if it is a quiet morning, as the big money have pulled, will be pulling their money from the market, will be a quiet London session, a spike there. Maybe we see this spike toward during the opening. You might see this spike, and then this might be the schematics that we will see, but we expect the buy side to be used as the first rally and then the second part. The reason why I'm still holding that is because we are in a period seasonally. This is the period that we normally expect declining bearish price toward the summer months, and then the fall low to see the rally up to December. But we have not seen that this year. It is US election year. We have not seen it. So so the Fed is artificially manipulating, playing with this with the market, with the price, because of the election, and maybe because of some other geopolitics events. And if that is so, that they are still playing with bullish rally, then if you check the daily again, then we will be going to look for them to engineer liquidity again. What I said, they will be staying in this large range. They will be engineering liquidity and take it, engineering buy side liquidity and take it. They hear the rally to create this high, they engineer liquidity, buy side liquidity, and they take it here. They engineer liquidity way down and take it here, until we see that we have trade past the weekly equilibrium on a high time frame analysis. This swing low be taken clear. We see a market structure shift. I will be looking for bearish move, bullish move, but first engineering and then engage and then taking it. We will be here and we will be here seeing them trading, recording experience, and programming our own algorithm. I am hunting on the 5-minute chart. Here is where I'm looking at my 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 set of parameter. This is what we already can mark, and this gives us something to think about. These relative equal lows, and right below them you have this order block. This order block inside the 15-minute 50-minute middle and left, right, inside the 50-minute busy, we can expect, and it is reasonable, it is logic, it is obvious for us to accept price somehow to trade and gauge these liquidity if it is in London of prior to the trade to making a Judah swing, respecting this order block, start rallying aggressively toward the safe haven, these relative equal highs, to engage these liquidity, and then drop, and hopefully the drop will be after the non-farm payroll week, non-farm payroll event, and we will just enjoy those rides. What can happen? The schematics I just paint is that price can open, drop to engage these relative equal lows into the order block, rally toward the engagement of that, and then start dropping to this side. That is what can happen. That is a schematic we will be looking at for price delivery. What can also happen is that on both sides we see here buy side liquidity, relative equal high, so sell side liquidity, and then bottom left, good, and then the same we have there, we have relative not relative equal, we have swing high, and we have there buy side liquidity, and we want to put them top and so forth. On this chart, what I normally do is that I take the PM session range, that is from that's the lowest low, that is this, and the high of the PM session, that is still 1600 close, is high. So for me, going forward tomorrow in my hunting, if it was a normal trading week, trading day, I will be looking from the opening, where is price relative to this range, and if it has engaged first this PM session high, first this one engage, I will expect them to drop to engage the sell side. It is with a normal trading day, but tomorrow is not a normal trading day. It is a trading day that is going to be subjected to manual intervention by the market makers using the data of non-farm payroll, and they will and we will be seeing some trading. We are going with the idea that price may drop, giving this idea that really this is a strong resistance, and price have not yet and will not come there and drop further, taking these relative equal lows, maybe till taking this one also, and then rally toward the buy side at the non-farm payroll event for us to see after the event that will drop to the sell side. That is how I geared my mind. This is the 5 minute, my execution time frame. I can trade on the 1 minute and less, just to limit the risk that I have, or I use micro contract, which is ESM 24, where I risk instead of 20 and 50 US dollar per handle, I can use their 5 US per handle. With the Nasdaq and QHM, with the Nasdaq, it's the 5 minutes I want to see. We have the same scenario. Going to the 15 minute, I will be running the 50 minute. When the market open, we expect them to drop to this long tail first, give the impression go up to engage this one, maybe left some, but this is non-farm pair, and then drop to the sell side. And I'm so hoping that this side delivery will be after the non-farm payroll event, so we will have low resistance liquidity run, trading bearishly down. And we look at the 60 minute. What does the 60 minute say? Yes, I'm checking also the body, not just the wick, how they have wick pesticide. I'm looking at the body, how the body respect and doesn't trade further. So I'm thinking that we'll be going lower, but first manipulation and intervention will take us up here and then there, like this, and there. What do we have here? Let me check the YMM, the Dow Jones. We don't trade him, we just use him as barometer, and here we create a relative two strong angle balanced price range. We'll be looking at the point of this. Now price is at the equilibrium of it, and price may trade and spike to that and close below this and trade lower to sell side objective. That is what we are going to be hunting and looking. The dollar index I have seen that price drop and indeed have engaged these relative equal low, but left this one still intact and have left also a low right below this one. We think price can, with the non-farm payroll, even drop down to these lows, and if it drop down to this low, it will be risk off. So the equity market index future will be allowed to trade to the upside, and then afterwards, after non-farm payroll, trade above. It left for us to see. We don't trade it, we don't trade ahead of it, we don't try to predict what they will do, for it is manual intervention, and we don't really know what they will deploy. Let me see what the euro US dollar do. The fiber, if the dollar goes down, this will rally to cover this one and maybe this one, and if it drop fast mark to market, it can reach and engage this buy side liquidity, and then afterward trade to engage these sell side objectives. Let me see the British pound USD. It's the same scenario. We want to see price. If dollar drop, risk off, mark to market, the foreign exchange market will rally, and when they rally, and later after the event, drop to engage this beautiful efficiency and liquidity that is below market price in accordance to the seasonal influence. I check the gold market, go to go this one. I check the gold market. The gold market is dollar index is inversely related with the gold. So if dollar going up, if gold is going up, dollar will be dropping, and if dollar drop, then we will see fiber and all the other go higher. So what we are seeing here with the gold, if it is in step, we are seeing inefficiency here. That's why we call it the markets with Odinga. Now we are actually on forex exchange territory. We see this one already have been rebalanced. There is one above this. This might be the catalyst for the US dollar and a big inefficiency above price with relative equal high might be the catalyst to see the dollar go up, meaning another dollar gold rally up, meaning that dollar will go down, and if dollar drop down, then we can see all the other markets go up first to engage the liquidity that is above marketplace on the other side, and then we like to see the drop of the we want to see dollar drop and see sell side objective. Crude oil futures is also a market that you can see and check what will happen. For now we stay out of these markets. I trade only the future index, but I can read also the other market for price is price. This opening price, if price violated, it will continue to rally higher. For this is reason you may call this is an order block, and this is propulsion block. If it violates it, propulsion block, an order block dipping into an previous order block, this is propulsion block, and this propulsion may propel price toward that side. But I'm looking first for it to drop, manipulate, and then go to the side to further drop down. The idea is clear. Nasdaq NQM I am trading on the ES, and if you see, this is where I have fully annotated the chart. The idea is that in time after I program and have been programming the algorithm, that I will be able to trade naked using only what I see in the chart and making less and less annotation. For now, I am submitting myself to the process to have them here, and I think they are clear, and that my viewers will see what level are being respected from the price delivery continuing perspective. This is the daily review. Tomorrow is a trading day. Algoro and I are going to trade after CPI. I actually invite you, continue to come. Let us see what we have predict, and how we have been consistently applying ICT concept, reading the tape, prerequisite to trading well. And even on daily and live trading, you need tape reading. And even if you are a professional between trades, tape reading is what what professionals are doing for their life. So We are focusing on applying these concepts and reading tape as much as possible, gaining experience, logging them, recording them, so that we can use those experience and trade well in time. I'm greeting you once more from Suriname, and I have this